Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. Today, we're diving deep into a stack of recent reports. We really want to unpack the major movements in the financial world, particularly focusing on the impact of President Trump's recent tariff announcements and, well, the market reactions that followed. You shared these articles with us, and our mission today is to distill the most important insights for you, kind of cut through the noise, help you understand what's really going on and maybe what it means for the future.
Yeah, it's quite a collection you've pulled together. MarketWatch, Bloomberg, CNBC. We're really looking at a real-time snapshot here, aren't we? Market anxieties, strategic shifts, all seemingly driven by these tariff policies. So we'll try to connect the dots between, well, everything from specific stocks to the bigger economic picture.
Okay, let's unpack this, just scanning the headlines. MarketWatch is looking at Mark Minervini's rules for winning stocks, which is interesting. But they're also sounding the alarm, maybe, about a potential recession from these tariffs.
Yeah.
And comparing silver and gold, plus looking ahead to Tesla's earnings, that's a lot just from MarketWatch.
And Bloomberg's coverage is, well, extensive. They're hitting Bitcoin's rebound tied to dollar weakness and worries about Fed independence, interestingly enough. Then there's the shift towards Asian consumer staples as a sort of tariff haven.
Right, I saw that. And gold hitting record highs, also tied to trade fears and the weak dollar.
Exactly. Plus, investors getting defensive despite some market bounces, Asian stock movements, the focus on tariff talks, and U.S. futures and the dollar sinking on those comments about Powell.
Yeah, that Powell story keeps coming up.
And Bloomberg also mentions the souring U.S. profit outlook, that rush to move Bitcoin mining gear out of Asia, and this idea about U.S. exceptionalism being challenged, pushing investors towards emerging market local bonds. It's a lot.
And finally, CNBC. They've got Chicago Fed President Austin Goolsbee warning about a potential summer slowdown. He links it to inventory stockpiling ahead of tariffs. And of course, another piece on President Trump renewing calls for lower rates and criticizing Fed Chair Powell again.
You know, when you lay it all out like that, the interconnectedness is just striking. It really does feel like a spider web, maybe, with tariffs at the center and everything else reacting.
Yeah, different asset classes, economic signs,
Yeah.
all vibrating from that one point.
So for our listeners, the challenge is seeing how these seemingly separate stories are actually part of the same narrative. Where should we start to make sense of it all?
I think we have to start with the tariffs themselves and the economic worries they're sparking. It seems like the most direct link. Several sources, like that Bloomberg piece on Bitcoin mining gear and CNBC with Goolsbee, they point to President Trump's April 2nd announcement as a key trigger.
Right, that seems to be the inflection point everyone's reacting to.
And it's important to remember, like CNBC mentioned, while many countries got that 90-day pause, China didn't. They're still facing potentially very high tariffs, up to 145% in some cases.
And that initial announcement, as Bloomberg covered it in their Bitcoin piece, definitely caused immediate turmoil. Uncertainty just shot up.
Yeah, volatility spiked. You could see investors just trying to figure out the potential fallout.
And it wasn't just a quick market dip, was it? Austin Goolsbee over at the Chicago Fed brought up that really interesting point in the CNBC article about preemptive purchasing.
Right. Businesses, maybe even consumers, rushing to buy things like cars or electronics before tariffs hit and prices go up.
Exactly. Which means, and this is key for listeners, current economic numbers might look okay, maybe even strong.
But it might be borrowed strength.
Precisely. Goolsbee's worry is that this boost now could lead to a significant slowdown later, maybe this summer, as that demand just vanishes because everyone already bought what they needed.
And then you get the more direct recession warnings. MarketWatch had that piece quoting economist Torsten Slok. He put a 90% chance on a recession if the tariff policies don't change.
90%, that's stark.
Yeah, he argued the GDP impact could be worse than the 2018 China trade war. And he specifically mentioned small businesses being really vulnerable here, less wiggle room to absorb costs.
Slok's point really highlights the potential downside. It's not just theory, it could mean real job losses, businesses struggling, and as another MarketWatch piece noted, economists don't even agree on whether the long-term effect is inflationary or deflationary. More uncertainty.
Okay, so that's the direct economic fear. But another huge theme running through these reports is the Federal Reserve's independence.
The criticism of Chair Powell.
Exactly. President Trump's public comments and those reports from CNBC and Bloomberg about the White House even considering his removal.
And that really spooks the markets, doesn't it? Bloomberg highlighted how concerns about Fed independence pushed the dollar index down sharply, what was it, a 15-month low?
Yeah, something like that. And at the same time, money flowed into safe havens. Gold jumped.
So the takeaway for listeners is pretty clear. Any hint of political meddling with the Fed, it hits the dollar, it hits investor confidence fast.
And it's not just market jitters. Figures like Christopher Wong, quoted by Bloomberg, and even the French finance minister, they're voicing concerns about trust in the dollar globally, the stability of the whole U.S. system if the Fed isn't seen as independent.
Absolutely. Central bank credibility is, well, everything. If markets think politics, not economics, are driving rate decisions, confidence just evaporates, both here and abroad.
And we're seeing signs of that already. Didn't Deutsche Bank report something?
Yes, Bloomberg mentioned it. Chinese clients reportedly cutting back on U.S. treasuries, moving into European debt, Japanese bonds, and gold. That's a potentially significant shift away from U.S. assets people should watch.
Speaking of gold, it's certainly been a star performer. Bloomberg's Gold Hits record piece detailed that rally, clearly driven by the weak dollar we just talked about and, ongoing trade war fears.
Yeah, and they mentioned that Goldman Sachs forecast, gold potentially hitting $4,000 by mid-2026.
Wild. But it shows the level of long-term uncertainty baked in, right? Gold as that traditional hedge against, everything going wrong.
It really does. Inflation, geopolitical risk, gold loves this kind of environment.
But here's where it gets interesting. Compare gold to silver. MarketWatch asked if silver might actually be the better bet now, because while gold's hitting records, silver's kind of lagged.
Well, yeah, and that difference really boils down to their uses, doesn't it? As MarketWatch explained, quoting Stefan Gleason, I think it was, silver is much more of an industrial metal.
Ah, right. So fears of an economic slowdown, less global trade, that hurts silver demand.
Exactly. It kind of counteracts its safe haven appeal. Gold doesn't really have that industrial drag. It's mostly just seen as money, a store of value.
So different drivers, even though they're both precious metals.
Precisely.
But that MarketWatch piece also made a case for silver. That gold to silver ratio. It's historically super high, right? Top to 100.
It did, which historically suggests silver could be really undervalued compared to gold.
So if the ratio reverts back to normal, or if economic sentiment picks up, silver could outperform.
That's the argument. Plus, they mentioned a supply deficit in silver, according to the Silver Institute data. So the supply-demand picture looks potentially bullish, too.
Interesting. A contrarian play, maybe.
Could be. It shows how looking at relative value can uncover opportunities.
Okay, so with all this uncertainty swirling, where are investors actually putting their money? We're seeing shifts.
Definitely. Bloomberg had that piece. Fidelity, Goldman find tariff haven in Asian consumer stocks. Basically, money moving into Asian companies that sell essential stuff, food, drinks mainly to their own local population.
So they're seen as insulated from global trade wars. Their demand is domestic.
Pretty much. Goldman and Morgan Stanley strategists, cited by Bloomberg, see them as more resilient. They might even get a boost from local government stimulus.
And Fidelity boosting its holdings in Chinese consumer stocks backs that up. A defensive move within equities.
Exactly. And it's not just geography. There's a broader rotation happening. Bloomberg's stock investors brace for more pain talked about money moving away from high-growth tech, especially AI names.
Like NVIDIA, AMD.
Yeah, those types. And moving towards more traditional defensive sectors, utilities, consumer staples again, healthcare.
So less focus on growth, more on just preserving capital.
That's the idea. These sectors are typically less sensitive to economic bumps. A flight to safety within the stock market itself. Listeners should be aware of that rotation.
And then there was that surprising trend in emerging market bonds. That Bloomberg piece, threat to U.S. exceptionalism.
Yeah, local currency bonds in emerging markets are gaining traction, which is counterintuitive. Usually they're seen as riskier.
So why now?
Well, it's a combination. Expectations that developing nations will cut interest rates. The weak U.S. dollar makes those local currencies more attractive.
And the slowing U.S. economy kind of justifies those potential rate cuts elsewhere.
Right. And the really unusual part, some of these riskier EM bonds now yield less than U.S. treasuries. It shows investors are really looking outside the usual places for returns, given the U.S. uncertainty.
Okay, let's zoom in on one company getting a lot of attention, Tesla. MarketWatch had that preview of their earnings, highlighting the challenges. Sales decline year over year, investor anxiety.
Yeah, Tesla stock has had a rough year, no doubt. That earnings report is going to be under a microscope. Investors want reassurance on sales, updates on the cheaper model, the robo-taxi stuff, and just a clear strategic direction.
Plus worries about competition and maybe the impact of Elon Musk's public profile on the brand?
Those are definitely factors too.
And even though Tesla makes a lot of cars in the U.S., they're not totally immune, are they? MarketWatch suggested that if tariffs slow the whole economy and hurt overall consumer demand for big-ticket items like cars, Tesla could still feel the pinch.
That's a really important point. Even domestic firms suffer if tariffs drag down the whole economy. It's all connected.
Looking at the bigger market picture again, Morgan Stanley's Michael Wilson had some sobering thoughts in that Bloomberg piece on the U.S. profit outlook.
Yeah, he said the outlook is rarely this sour. Analysts are slashing earnings estimates left and right.
Why? Just recession risk.
Mainly, yeah. Recession fears, general uncertainty.
Yeah.
It's making companies and analysts cautious. And Wilson pointed out this divergence. The S&P 500 might be holding up okay, but the earnings revision's breadth.
Meaning more analysts lowering forecasts than raising them.
Exactly, by a wide margin. He suggests that might mean the underlying correction in profits is worse than the index level shows.
And we even saw a very direct physical reaction to tariffs with the Bitcoin miners, didn't we?
Oh yeah, that Bloomberg story about the rush to get Bitcoin mining gear out of Asia?
Yeah.
The initial tariff threat apparently caused a mad scramble to move millions of dollars worth of equipment out of Southeast Asia. Huge cost, huge disruption.
Just shows the immediate real-world impact these policies can have, even just the threat of them.
Definitely. A good example of the ripple effects.
Okay, finally, let's touch on Mark Minervini's perspective from that MarketWatch article, Finding the Next Winners. He thinks the Magnificent Seven dominance might be over.
That's his view. Minervini, who's a successful investing champ, has a specific method. His big criteria, according to MarketWatch, stock trading above its 200-day moving average.
Okay.
And crucially, that 200-day average itself has to be trending upwards. He claims 99% of the biggest winners historically fit that pattern.
So it's about momentum, not finding bargains.
Exactly. He also wants the stock near its 52-week high, showing relative strength, especially when the market dips. It's very different from value investing.
So applying that now, he'd be looking beyond the current giants, towards smaller, innovative companies showing that kind of price strength.
That seems to be the implication, looking for leadership in maybe less obvious places, using those technical signals as a guide. It gives listeners a concrete framework anyway.
Okay, wow. So summing up, it's a really complex picture, isn't it? Everything seems heavily influenced by these trade tensions, the uncertainty they create. We've gone from potential recession risks and a weaker dollar to how investors are shifting strategies, looking for safety, maybe finding the next big thing.
And the connections are clear. Tariff fears hit the dollar, boost gold, push investors to defensive stocks, or even emerging market bonds. It all ties together.
Understanding those underlying links really seems key to navigating things right now.
Absolutely. We touched on Minervini's approach, the gold versus silver debate, that defensive shift in stocks, Tesla's specific pressures, and always coming back to the influence of those trade policies and the reactions, including the focus on the Fed's independence.
So the big questions going forward seem to be, what happens with these tariffs? Will they stick? How broad will they be? And how will the Fed react to all this? Inflation worries on one side, slowdown fears on the other.
And will market anxiety eventually give way to, well, something more positive? Or is this the new normal for a while?
Lots for listeners to think about, definitely, how these big macro trends might impact their own decisions. This deep dive really just gives a snapshot of a situation that's changing rapidly. Keeping an eye on trade talks, economic data, Fed signals. It's going to be crucial.
Yeah, continue to watch those sources. Consider the different angles they present. It helps build a fuller picture.
We'll see you all tomorrow morning with new headlines from major financial magazines.